Hello and welcome to the second lecture of the week 10, where basically in continuation of the last class we'll talking about the volatility models. As we have discussed in the last class, volatility basically measures the degree of variation or fluctuations in the prices of the different assets over an specified period of time. There have been continued interest in the development to model or forecast or predict the stock market volatility. There is vast literature, theoretical as well as the empirical literatures are there on for modeling and forecasting the stock market volatility. Why there have been so continued interest and why there has been so much interest in modeling volatility and forecasting volatility is because this volatility is one of the most important concept we have in finance, which is related to every asset. Often we measure by the standard deviation or the variance of returns, and we use these measures as a proxy or the indicator of the total risk of any financial assets. It is used in many value at risk models for measuring the market risk. It is a direct input required in the Black-Scholes option pricing model. It is a direct input in the Black-Scholes formula for deriving the prices of the traded options. There are the certain features of volatility which makes it very important or which has generated the interest among the academics as well as the practitioners about the volatility modeling. So, one of the simplest model for the volatility modeling is the historical volatility model. So, what is the historical volatility model? It is a basically statistical measure of the dispersion of the returns for any financial instrument over a specified period of time. It is computed using the past prices of an asset and is expressed as annualized standard deviation of the returns. So, here we use this the historical volatility as the volatility forecast for the all future periods. So, how we calculate? So, there are the certain steps we follow. The first, let us assume PT is the price of an asset. Then we take the return of that asset using the logarithmic form log here. Then we have to calculate the mean, which is nothing but the average of the returns which we have calculated here over a specified period of time. Then we calculate the variance of that using this particular formula. Then obviously if you take the square root, that becomes nothing but the standard deviation. However, often this standard deviation is represented in form of the annualized. So, how we convert this into the annualized form? So, the general formula is this: the sigma annualized, that is the historical volatility, is equal to sigma square root of t, where t basically represents the trading days per year. For example, if we have the daily price data and there are the 252 trading days, then we will multiply this sigma with 252. Correspondingly, if it is week, we know there will be the 52 week in the non-leap years. If it is monthly, then we know there is a 12. So, these are the things this formula we can use to convert the standard deviation into the annualized standard deviation, which is the measure of the historical volatility. So, these are the steps we follow to calculate the historical volatility. What are the different methods we have to calculate the historical volatility? There are broadly 5 methods. What we have: the close to close volatility, Parkinson's high-low volatility, German class volatility, and Rogers-Schachel volatility, and Yang and Zhang volatility. So what is the close to close volatility? Basically, when we use this daily closing prices to compute the historical volatility, that is known as the close to close volatility. Here, when we are calculating RT log of PT upon PT minus 1, so this price PT is basically the closing price. On the other hand, in the Parkinson's high-low volatility, instead of using the close prices, what we use the intraday high and low prices for a more accurate estimate. So here ST is the basically high price for the day and LT is the low price for the day. So what is the German class volatility? It basically extends the Parkinson's method by including the opening and the closing prices, whereas the Parkinson method is also only restricted to the high and low. Here it includes both high and low as well as the opening and closing prices. So here the CT is the closing and OT is the opening prices, and this ST as usual is the high prices of the day, and this L is the lowest price of the day. Another measure is the Rogers-Satchel volatility, which is basically useful when we have the drift in the assets. So this is again uses the both high and low and closing and opening prices of the day, and using this particular formula we can calculate the Rogers-Satchel volatility, and it is useful when the assets have drift. And the last measure is the Yang-Jones volatility, which is basically hybrid model combining overnight and intraday returns. Here again open price and the close prices of the previous period, and here again the high and low prices of the day. Here this WO and WC is the weights for overnight and close to close returns, and we can use this particular formula to calculate the Yang-Jones volatility. So these are the 5 methods we have. Now these are the theoretical methods, and we will be using the sample to estimate the sample volatility, and these are the different methods we can use to calculate those sample volatility. Let us say at time period T we have estimated the sample volatility, that is the standard deviation of the asset at T. We have this sigma hat T here, that is the estimated, that, or we can say the sample volatility we have. Now here if this T indexes months with daily data, then is the sample standard deviation of the daily returns in the month T. Whereas if the T refers the days, then this will be the daily data, and we have sigma hat square equal R square T. On the other hand, if we have the high frequency data, then this daily sigma T is derived from cumulative squared intraday returns. Then how we can use this to make the prediction? What are the methods we can use that? So one of the method is the historical average. So here we calculate the or estimate or predict the historical volatility at time period T plus 1, and here we use all the available data from period 1 to T. So that is known as the historical average method to predict the historical volatility. Another method is the simple moving average method, where again we are using T plus 1, that is the predicting the volatility at time T plus 1. However, here we are using the last M single period sample estimate. So basically we are taking one step ahead, and we are taking the simple moving average of that. So that's basically here we use this. Then another prediction method is the exponential moving average method, which is again here predicting here, and we use this where this the value of beta is less than or equal to 1 and more than or equal to 0. Again here all the available observations we use to predict this. On the other hand, when we have exponential weighted moving average model, we use the particular formula here where this beta j and up to last m, so we keep on increasing. One interesting factor here of this is that here basically we give more importance, assign more weights to the recent observations and we gave lesser weight to the distant observations. There are other methods also we have, and another important method is the simple regression, where basically we predict using the previous observations of the historical volatility. However, this looks like similar as we have discussed about the autoregressive process. However, this is different than the autoregressive moving process. Now here the regression can be fit using all the data, or we can adopt the rolling window approach, where basically we use a specific observation in periods. So either we can use all the observations and we regress and we estimate the value of this, or we can use the rolling window approach. There are the trade-offs we have. What trade-offs we have? If we use more data, the precision of the estimates will be more good or better. However, if you are using the less few data, that means we are giving more weightage to the recent observations compared to the past distant observations. So if you are keeping your number of observations less, then there is the chance of more error. Whereas if you are increasing more observations, then there is chance for the more precise estimators. However, it will give also weightage to the distant observations. So there we have always a trade-off. However, once we estimate, then it should be evaluated. So how we use that? So there are the different methods we have. So the distinguish assets and the asset classes, it will be different for the different assets and the asset classes. We should also try the different sampling frequency and the forecast horizon to assess or to evaluate the out of sample performance or the forecast of those models. The second, there are the different measures are available. For example, mean square error or mean absolute error or mean absolute percentage error. There are many other measures which we can use to assess the reliability or authenticity of the out of sample performance, or we can say of the predicted volatility. There are the benchmark methodology, which is often known as the risk matrix. So we use this risk matrix to evaluate the forecasted volatility values. However, there are many other methods are also there for the prediction. For example, historical simulation methods. This simulates the future price paths using the historical returns to estimate the volatility. Or we have the bootstrapping. Basically, randomly we sample the past return to simulate the possible future price scenario, and then we use those price scenario to calculate the historical volatility. Or we can also use the regression based prediction. So here in this regression based prediction, we are not regressing on the past observations of the volatility, rather than we are using other macroeconomic factors to predict about that. For example, we can take the volume, or we can take the GDP, investment, inflation, or other macroeconomic variables to predict using this regression base. Or there have been recent development where the machine learning techniques, for example, this random forest or neural networks, can be used to predict about the historical volatility. Then another model we have that implied volatility. So basically, implied volatility is derived from the market prices of options using certain pricing formula. For example, Black-Scholes. This reflects the market expectation in the future price movement, unlike the historical volatility, which is basically backward looking. So implied volatility is the forward looking, whereas the historical volatility is basically backward looking. For example, let us say we have a Black-Scholes formula, then how we calculate the implied volatility. So we know that for an European call option, this Black-Scholes formula is given like this, where the D1 is S0 upon K plus R plus sigma square upon T and sigma square root T, where D2 is equal to D1 minus standard deviation square root t, where here the C basically represents the market price of the call option, S is 0 is the current stock price, and K is the strike price of the option, R is the risk-free interest rate, and T is the time to maturity, and here N represents the cumulative distribution function of the standard normal distribution. And here this sigma, this is nothing but the implied volatility. So we are concerned with this implied volatility. So how we do that? So here the objective is that find sigma such that this C market, that is market price of the call option, and the C model. So this model, if you are using this model to have the price C, both should equate. If you are able to equate, that will be the measure which we are concerned with the implied volatility. So how we do that? There are the different methods we have. One method we have what we call bisection method. It's basically a root finding algorithm. So what we do here? We define a lower bound and upper bound. Here we assume, we define, we make an assumption about the lower bound and upper bound of the implied volatility. Then iteratively we calculate the midpoint. Then objective is to reach here. So we calculate that midpoint. So we keep on narrowing the range until we get the desired precision, which basically gives us this equality, and that value of sigma is nothing but the implied volatility. Using the bisection method we will get. Second method is Newton-Raphson method. The same, it also follows the iterative, but it is a basically faster iterative methods using the derivatives. So here the idea is this: sigma n plus 1 is equal to sigma n minus this initial value. So ultimately we have this particular value here. So again this measure gives us the new sigma, that is the volatility method here. Then we have implied volatility surface, a concept related to implied volatility. What it says? It says this implied volatility, how it varies with the moneyness and the time to maturity. So what is the moneyness? Moneyness is basically the relationship between the strike price and the current price. In the money, then, so this shows the relationship between this moneyness and time to maturity. And if we plot that, we will have shape, and that based on the shapes we call it the volatility smile and volatility skewness. Volatility smile, here basically it reflects that this implied volatility increases for deep ITM, that is in the money, and OTM option, that is out of money. In the money, when the current price is more than the strike price; out of money, when the current price is less than the strike price. So when the current price is more than the strike price, then we will sell, that is in the money. So if we draw that relationship, it gives a shape of the smile, what we call the volatility smile. Second is the volatility skew, then asymmetric changes with the moneyness. Okay, that this relationship between moneyness and maturity is not the same, it changes. So what it reflects? It reflects that this volatility is not constant. It is changing based on the relationship of moneyness and maturity. Whereas in the Black-Scholes formula, we assume that the volatility is constant. However, both this historical volatility and the implied volatility has the certain drawbacks. What are the drawbacks we have? If you look at the historical volatility, it reflects the past data, so lacking in the real-time market changes. So because it is based on the past observations, it cannot capture what is happening currently into the market, into that particular financial asset. Another drawback, here we assume that the volatility is stationary, which is often realistic. It is ignores the forward-looking market sentiment. People do behave based on what is going to happen in the next period, but here we are looking towards the back. We are not considering the expectation about the future. It also fails to capture the volatility clustering and the jump risk. Another, there is no suitable for the pricing options unlike the implied volatility. So, we cannot use the historical volatility into the pricing option formula. So, for that we use the implied volatility. However, implied volatility also has the certain drawbacks. What are the drawbacks we have? The first thing, we derive the implied volatility from a option pricing formula. So, that means it will depend on the assumptions of that option pricing formula. So, if the assumptions are not realistic, that means the implied volatility will be also not a realistic measure. It is influenced by the market inefficiency and the liquidity constant, because that affects the relationship between the option pricing. Varies with the moneyness and time to maturity. That is what we have discussed. It may show the volatility skew or volatility smile, so it is not a constant. Then it is also sensitive to short-term events, lacking long-term accuracy. In the short term, if any events happens, the pricing of the options will be changed and the implied volatility will also change. It is not always a reliable predictor of the realized volatility. Realized volatility, basically all the volatility which we measure based on the observed the prices. So, this also has this certain empirical issue. Then in the next class we will be discussing, where we will try to discuss such models which has the capacity or which has the feature to do away with these drawbacks. So, see you in the next class, where we will discussing the primarily autoregressive conditional heteroscedasticity model, which is based on the concept of time varying nature of the volatility. Thank you so much.